Hey guys, Chris from adapttuition here, and this is video number 6 in my error correction series. If you want to see the other videos on this playlist, I'm going to put a card up there and a link in the description below. So be sure to check those out as well. So in this video, I'm going to show you how to correct net profit after errors were made. So in the previous videos in this series, I dealt with errors that either affected the agreement of the trial balance or didn't affect the agreement of the trial balance. And we saw that we used the general journal to correct those errors in the accounting records. Now, some of those errors would undoubtedly affect revenue items and or expense items. And as we know, at the end of a financial period, we prepare the financial statements, the income statement and the balance sheet, the statement of financial position. So if there were errors affecting any of the items that appear in those statements themselves would have errors that we would need to fix. In the case of the income statement, our ultimate figure, the net profit or net income, if you refer to it like that, that is going to be off. So what's going to happen is that when we correct the figures for either revenue items or expense items or any other items that appear in the income statement, we're also going to have to fix the net income. Now, the truth is, when we correct the errors, we are probably going to redraft or redo the entire income statement to arrive at the correct net profit. But there also needs to be a statement that reconciles the incorrect net profit to the correct net profit. It shows that we know why our profit was incorrect in the first place. So there are 4 categories of items that I'm going to show you how to deal with in this video as it pertains to correcting net income: revenues, expenses, the returns items, and the inventory item. So yes, there may be other items that might not fall into any of those 4 categories that appear in the income statement, but by learning how to deal with these 4, we will be in a good position to know or figure out how to deal with items that may not fall under any of those categories, but may still appear in the income statement. And with all that said, let's get into the work. Oh, but before we get into it, be sure to have your writing material ready to take down your notes, because as we go along, you're going to want to jot down some of these things so that you can remember it for future purposes. Okay, let's go. Okay, so the first category of items that we are going to be dealing with is revenue items. So as you can see here, we know what revenue is, right? Revenue is earned from providing either a good or a service, and it is one of the 2 components in the calculation of profit, the other being expenses. So of course, we know if we make an error in recording revenue, it means that our profit figure is going to be off. Let's take a look at the example. So it says here, Hannah Banana Chana's net income for the year ended 31st March 2016 was calculated as $56,000. However, the following errors were discovered. So it says that sales revenue was understated by $6,000 and rent revenue was overstated by $1,000. Now, when something is understated, that means the figure is too low. So what they're saying here is our sales revenue figure is too low. So if you think about it, if your revenue is too low, your profit is also going to be too low. By the same token, rent revenue was overstated, which means we put too much rent revenue in the income statement. And if you overstate your revenue, your profit is going to be too high as well. So what's going to happen is that we are going to have to correct both of those errors individually, and then we're going to have to correct the net profit for the correction of those errors. And that latter item is what we are going to be focusing on. So what I want to do here is I want to go across to an income statement and show you the effects of each of these errors on net profit and what happens when we correct those errors. Okay, so here we have an income statement for illustrative concepts for the year ended 31st December 2020. I put that in because that was the time I was supposed to bring this video out originally, but it's December 2021, so, well, better late than never, okay? Right, so we have an income statement here. Now, these figures are independent of the example. They have no connection to the examples, but I'm going to use this income statement to help illustrate the effects of the errors on net income and what happens to net income when we correct the errors. So the first item was that sales revenue was understated by $6,000. So we are going to understate sales revenue by $6,000. Now look at what happened there. Sales revenue was $90,000 and now it's $84,000. It's too low. As you can see here, it says understated by $6,000. Now look at net income. It says $24,000 and it says understated. Now let's kind of undo this to get an idea of what it looked like originally. So the net income was originally $30,000. Sales revenue was originally $90,000. Okay, So if it was originally 30 and then we understated sales revenue, look, it went down from 30 to 24. That's an understatement by 6. So whatever direction revenue goes, profit goes in the same direction. That's a good thing to remember. Okay, so if revenue is understated, net income or net profit is understated too. Now, what's going to happen when we correct that? So when we correct the understatement, revenue is going to go up. And if revenue goes up, profit goes up as well. Let's take a look. If we remove the error, if we remove the understatement of 6,000, this is going to go up. Sales revenue is going to go up from 84 to 90. And I bet you that net income is going to go up from 24 to 30. Let's take a look. There you go. See, we removed the understatement. Sales revenue went up to 90 and net income went up to 30. So when you correct the understatement of revenue, revenue goes up. And if revenue goes up, profit goes up as well. Now, on the other hand, rent revenue was overstated by $1,000. So we're going to put in 1,000 here and rent revenue. So if this is overstated, it's going to go up by, well, in this case, 1,000 because overstated means too high. So this is going to go up to 9. And I bet you that net income is also going to be too high. It's going to go up to 31. Let's take a look. Let's overstate rent revenue. So you see, it went up to 9. And look at net income. It went up to 31. It went up from 30 to 31. And that's an overstatement by 1,000. So the overstatement in revenue produced an overstatement in net income. So when we correct the error, if revenue is overstated, it's too high. When we correct it, we're going to bring it down. And net income is going to come down along with it. Let's take a look. So if we remove the error, rent revenue is going to go down from 9 to 8. And we're going to notice that net income is going to go down from 31 to 30. Let's take a look. There you go. All right. So what we want to do now is we want to show how to present this in a kind of table, a little statement format. So let's go back to the Word document. Okay, so we have here a computation of corrected net income. To compute the corrected net income, you may use the format below. Again, it's a suggested format. There's no one right format. This is my suggestion. As you can see, I'm heading up correctly here. Name of the entity, what the statement is showing me, and the period to which it applies. So we're going to start off with our incorrect net income. That's 56,000. So you can label that net income before correction or whatever you think makes sense. That is logical. Now, sales revenue is understated. Now, what we are going to do is we are going to adjust this for the correction of this error. So if sales revenue was understated, that means it was too low. To fix that, we are going to increase sales revenue. And what's going to happen is that profit is going to rise as well. So we are going to have to add back the understated amount for sales revenue to correct the net income figure. Conversely, the rent revenue figure was overstated. Overstated means it was too high. To fix that, we're going to have to bring it down. And when we bring revenue down, profit comes down along with it. So we're going to have to subtract the amount of the overstated rent revenue in the process of correcting net income here. And when we do the arithmetic, we're going to end up with 61,000. That's the corrected net income. So you're going to start with your 56, add 6 minus 1, and that's going to give us 61 here. Now, yes, the whole income statement will probably be done over in order to show the correct net income statement to anybody who wants to see it. But like I said, this statement is done as a bit of a summary of the corrections that were made. Okay, so with that done, let me give you guys one to try. Okay, so we have the thing goes CRAS net income for the year ended December 31st, 2013 is 125,000. But the following errors were found. Sales revenue was overstated by 10,005 and discount received was understated by 12,000. So again, only revenue items, and you're required to show the calculation of the corrected net income. So I've left the example that we just did visible for you if you need it. So you know the drill, pause the video, try the question, and unpause to see the solution. Okay, so let's take a look. So we are going to start with the net income before correction. Okay, so please do pardon me for not putting the proper full heading. I just wanted to save some time here. So let's go to the errors. So sales revenue was overstated by 10,005. So overstated revenue is an error. That means it's too high. When we correct it, we're going to have to decrease the revenue figure. And when revenue decreases, profit decreases right along with it. So we are going to have to subtract the amount of the overstated sales revenue in the process of correcting the net income. Similarly, discount received, which is a revenue item, was understated by $12,000. Now, how do we fix that? What does understated mean? That means it's too low. To fix that, we have to increase it. And when we increase revenue, profit is going to increase along with it. So in the statement down here, we're going to have to add the understated amount for discount received. And when you do your arithmetic, you're going to end up with the corrected net income. Okay, how was that? If you have any questions, please leave them in the comment section below and I'll make sure to get back to you. Okay, let's take a look at how we deal with expenses now. Okay, so with respect to expenses, expenses are incurred and totaled and then subtracted from total revenue earned to arrive at the net income for the reporting period. So we know what it looks like in the income statement, right? We have our less expenses section. Don't forget your cost of goods sold. That's your expenses. That's literally a cost of the goods that you were selling. So that's also an expense item, but it has a bit more of a complicated calculation. So expenses are the costs of doing business, and we subtract expenses or costs from revenues in order to get profit. So if your expenses are overstated or understated, they're not correct, and hence any figure calculated on an incorrect figure will itself also be incorrect. Let's take a look at an example to see how this works. Okay, so example time. So the net income for Philip McGillicuddy for the year ended 31st December 2016 was calculated as $20,000. The following errors were later found. So we have rent expense for the period was overstated by $1,000 and wages expense for the period was understated by $800. So if an expense is overstated, that means it's too high. And if you subtract too much, if your expense is too high, you're taking away too much from revenue. So your profit is going to be too low. Similarly, if the expense was understated, that means it's too low. So we weren't subtracting enough from revenue, and therefore profit is going to be too high. So let's take a look at the income statement, like we did just now, to see the effects of these errors on net income and what effect correcting them will have on the net income figure as well. All right, so the first item was the rent expense. That's going to be overstated, by $1,000. So we're going to overstate rent by $1,000. Now, before I click it, just take a look. It's going to go up from $15,000 to $16,000. And think about it. We're going to be subtracting an extra $1,000 from revenue. So net income is going to go down to $29,000. Let's take a look at it. Right? So here, you see rent expense is now $16,000. It went up from $15,000 to $16,000. It's overstated by $1,000. But look at what happened to net income. It's now understated by $1,000. It went in the opposite direction. So expenses and profit move in the opposite direction, which is the reverse of what happened to revenue and profit. They go in the same direction. So overstated expenses cause understated net incomes. Now, when we correct the error, what's going to happen is the incorrect expense is going to go down, and then the corrected net income is going to go up. So again, they're moving in opposite directions. So if we remove the error, 16,000 is going to go back to 15, and net income is going to go up to 30. Now, the next thing that was happening was that wages and salaries was being understated, I think, by $800. So let's type in 800. So let's think about it first, right? So wages and salaries is going to go down by 800, which means you're going to have a lower than necessary expense. So you're not subtracting enough. So if you're not subtracting enough from revenue, what's going to happen is your profit figure is going to be too high. So this is going to go down to 24,200. This is going to go up to 30,008. Look at it, right? 24,200 understated by 800, 30,008 overstated by 800. So again, expenses went too low, so profit went too high. They move in opposite directions. So when we correct the error, what's going to happen? Well, wages and salaries is going to go back up, and profit is going to come back down. Let's take a look. If we remove the error, exactly that. Wages and salaries went back up to 25, and profit went back down to 30. So let's take a look at the statement version of this correction. Okay, so again, I headed it up properly in the example. Okay, so let's start with the 20,000 for the net income before corrections. Right, so rent expense was overstated. That means it was too high. To fix that, we have to bring it down. When expenses come down, profit goes up. So we're going to have to add the overstated amount of the rent expense in the process of correcting net income. The wages expense was understated. Understated means it was too low. When we fix it, the expense is going to go up. And when expenses go up, profit comes down. So we are going to have to subtract that in the process of correcting net income. And when you run your arithmetic, you're going to get 20,000 too. So we start with 20,000, we add back the overstated expense, we subtract the understated expense, and we end up with the corrected net income. Okay, so again, if you have any questions, please feel free to leave them in the comment section below. Let's take a look at the returns items now. Okay, so I made a mistake just now. So what I meant to say was, let me give you guys an example to try. Okay, so we have here Bonobo Gorilla Face has a net income for the year ended December 31st, 2015 of 25,000, but the following errors were found. So insurance expense was understated by 1,500 and cleaning expense was overstated by 2,000. So I've left the example that we just did visible for you guys to use if you need. So you know the drill, pause the video, try the question, and unpause, check the solution. Okay, so we're going to start off by heading up, statement of correcting net profit. Let's put the dollar sign and let's put the 25,000 of net profit before correction. So the insurance expense was understated. So understated means it's too low. When we fix it, we're going to increase it. And when we increase an expense, profit is going to go down. So that means that we're going to have to subtract the understated insurance expense figure. Conversely, the cleaning expense, which was overstated means it was too high. If your expense is too high, to fix it, you have to decrease it. And when you decrease expenses, profit is going to go up. Remember, they move in opposite directions. So we're going to have to add the overstated amount for the expense there. And when you run your arithmetic, you get 25,500. Okay. All right. So now let's get to the returns items. Okay. So I decided to go straight to the income statement to show you guys the effects that errors in the returns items would have on the net income, because I was trying to run through it before I recorded and I found it was getting a bit too complicated and a bit too confusing. At least that's how I felt. So I figured, here what? Let me change up things a little bit. So we're going to go straight to the income statement. Let's take a look at returns inwards first. Returns inwards, as you can see, is being subtracted from sales revenue. So we're subtracting returns inwards from sales revenue. Doesn't that sound like expenses like what we did just now? Expenses are subtracted from revenues in order to arrive at net income, right? Now, returns inwards is not an expense, but it is kind of treated, or it behaves like one. So let's take a look and see what happens to net income if we change up or make mistakes with returns inwards, right? So again, our hypothesis is that it behaves like an expense. So whichever way we have an error in returns inwards, profit is supposed to go in the opposite direction if our hypothesis holds. Okay, so let's use an easy figure. Let's use $1,000, all right? So if we have $1,000, let's overstate it. So if we overstate returns inwards, it means we're subtracting too much from sales revenue. So it means that the net sales is going to go down. So revenue is going to go down. So that also means that net income is going to go down as well, right? So if you follow that whole train, if we took away too much, if we subtracted too much from revenue, net income is going to be too low. Let's take a look. So this is going to go up to 6,000 because we're going to overstate it. So we're saying that this should go down to 29. Let's click overstate. Are we correct? Oops, I didn't click returns inwards. Let's check it out. There you go. It went up to 6,000, which is overstated by 1,000. And look at that. Net income is understated by 1,000, right? So our hypothesis seems to be working so far. So we saw that if returns in was overstated, net income was understated. So that behaves just like an expense. Let's see if the reverse holds true. Let's see if we understate returns in, if net income will go up. So that means this is going to go down to 4, which means we're not subtracting enough from revenue. And if we don't subtract enough from revenue, profit is going to be too high. So I think this hypothesis will hold. So right, we went down from 5 to 4, which is an understatement by 1,000. And look at that, net income went up by 1,000 because we didn't subtract enough via the returns in. So that's overstated by 1,000. Right, so what we're seeing here is that returns in behaves like an expense. Now again, returns in is not an expense. It is like a kind of anti-revenue, which is not the same as an expense, all right? But again, because it's anti-revenue or contra-revenue, that means it behaves like an expense. It's decreasing, its overall effect is to decrease net income. All right, so that's returns in. Let's take a look at returns out. Now, just so you know, returns out is here. We're subtracting returns out from purchases. Now, yes, it's purchases plus carriage inwards. But if we assume carriage inwards was 0, we're subtracting returns out from purchases. Purchases is an expense. And if you're taking something away from an expense, you're reducing the expense. And if expenses go down, profit goes up. So, let's take a look. So if we have 6,000 of returns outwards here, let's do the same 1,000 figure to change it by. Let's change it and see what happens to net income. So our hypothesis is, if we were to, let's say, increase, let's overstate it first. If we were to overstate returns outwards, we'd be subtracting too much from purchases, and your cost of goods sold would go down, which means you're not going to subtract enough from your revenue. And if you don't subtract enough from revenue, profit is going to be too high. Woo! This is kind of topsy-turvy, right? So let's just take a look at those items. Returns out, let's look at what happens when we overstate returns out, and let's look at net income. So our hypothesis is that they should move in the same direction. So we are going to overstate returns out. So that's going to go up from 6 to 7. So this should go up by 1. Let's take a look. Aha! It went up from 6 to 7, as we said, overstated by 1,000. And look at net income. It is also overstated by $1,000, which means that returns out, well, net income moved in the same direction as returns out. Now that was overstated. Understated should give us the same thing. Let's take a look. Let's just switch it one time right here. And look at that. It went down to 5, and this went down to 29. So we have a hypothesis, and we proved it. We proved that that returns in behaves like an expense and hence follows expense rules, and returns out behaves like a revenue and hence follows the revenue rules for correction. So you might want to write that down, and I know it could be a bit confusing. If you feel confused, don't feel badly. That's perfectly normal. Most people do. But again, you might want to rewatch the video, write it down, take a look at how the income statement changed when we change those items individually, right? And you can trace it through yourself. Don't be afraid to write over the whole income statement, or you know what, better yet, learn to use Excel, right? And when you change one thing, it'll change the other things, okay? All right, let's go back to the Word document and take a look at how we would do a statement to correct the issues with these two returns items. Okay, so returns in and out, so net income is 50,000, but the following errors are found. Returns in is overstated, and returns out is also overstated. Okay, so I'm not going to write a head up here. I'm just going to start with the net income of 50. So returns in behaves like an expense. If an expense is overstated, it's too high, and when we correct it, it comes down. And when expenses come down, profit goes up. So we're going to have to add that item, that overstated amount for returns in. If returns out is overstated, returns out behaves like a revenue. It is not a revenue, it behaves like one in the context of the income statement. So if it's overstated, it's too high. When we correct it, it's going to come down, which means profit is going to come down too, because they move in the same direction. So we're going to have to subtract that item here, right? And of course, we're going to end up with a corrected net income, which is slightly larger than the initial one. Okay, now let's do a second example, just because I want to show you guys the other movement in both of these items. Right, so we have example 3B, returns in and returns out, net income of 60. Returns in is understated by 2, returns out is understated by 5. So let's start with net income before corrections of 60. So if returns in is understated, that means it's too low. Now remember, returns in behaves like an expense. If it's too low, in order to fix it, we have to increase it. And when you increase an expense, what happens? Profit goes down. So we're going to have to subtract, we're going to have to subtract this item in the process of correcting net income. Similarly, returns out is also understated. Returns out behaves like a revenue. If it's understated, that means it's too low. And when we correct it, we're going to increase it. And if you increase a revenue item, profit or net income increases along with it. So we're going to have to add that as well in the context of correcting net income. Okay, so now that we've seen these two examples, I want to give you guys a couple of questions to try. Okay, so I've put both questions up on the screen at the same time, and I've left both examples. So pause, try the questions, and then unpause to see the solutions. Okay, did you try it? How did they go? A little confusing? Was it okay? No judgment. Remember, we're here to learn. All right, so in practice exercise 3A, net income is 54,000, but the following errors were found. Returns out was overstated, and returns in was understated. So, okay, we have a one going up, one going down. Deal with one at a time. let's start off by dealing with the, the net income before correction, 54,000. Okay, so returns out behaves like a revenue. If it's overstated, it's too high. To correct it, we have to decrease it. And when you decrease revenue, profit on net income decreases as well. So we're going to have to subtract the overstated returns out amount in order to correct net income. Similarly, returns in was understated. Now, understated means it's too low, and returns in behaves like an expense. So it's too low. To fix it, we have to increase it. And when you increase it, when you increase an expense item, profit on net income comes down. So this is also going to be subtracted as well. So corrected net income is 49.8. All right, now for exercise 3B, we're seeing net income is 62. But we have returns in being overstated and returns out being understated. Now let's start with the net income figure before correction. So returns in behaves like an expense, and if it's overstated, it's too high. If it's too high, to fix it, we have to decrease it. And when you decrease an expense item, profit goes up. Because profit and expense is moving the opposite direction. So we're going to have to add the overstated returns in to correct the net income. Returns out was understated by 7,500. Returns out behaves like a revenue. As such, what's going to happen is if it's understated, it's too low. If it's too low, to correct it, we have to increase it. And when you increase a revenue item, profit on that income increases right along with it. So we're going to have to add this one as well. And then when we do our arithmetic, we get 73.1. Okay, so how are we feeling so far? Half and half? Pretty good, pretty bad? Let me know in the comments below how you're getting along. Okay guys, let's take a look at the inventory items. Okay, so just like with the returns items, the inventory items have a kind of complicated relationship with net income. Not really, but some people feel that way. So I wanted to go straight to the income statement instead of trying to explain it too much without showing you this. So let's go here. So opening stock, as we could see, the opening inventory is added in the course of computing cost of goods sold, which is then subtracted from returns in. So cost of goods sold is an expense. Opening stock is one of its components, that increases it. Now, again, if you're not following all that, let's just look at what happens to net income when we change opening stock. Opening stock, right? So let's leave it with $1,000 and let's overstate it first of all. So if we overstate opening stock, it's going to go up to 13, which means cost of goods sold is going to go up to 29, which means that this is going to go down to 56 and this is going to go to 29. So again, it's a whole chain of events. Let's just focus on opening stock and net income. So I'm going to overstate opening stock, right? Overstate opening stock by 1,000. So it's going to go up to 13 and this is supposed to go down. Let's see if that works. Right, there you go. 13,000 overstated by 1,000 and 29 understated by 1,000. All right, so like I said, they moved in opposite directions. And if we switch it, hold on, let's clear out the error. And what we want to do is we want to switch it to understate. So if we understate it instead now, it's going to go down to 11. Let's see if this goes up to 31. Yep, there you go. It went down to 11, understated by 1,000. And this net income went up to 31, overstated by 1. So as we could see, opening stock behaves like an expense. When it goes up, profit goes down. When it goes down, profit goes up. So remember that. Opening stock behaves like an expense. So let's clear out those items now and let's take a look at closing stock. So you might be thinking, okay, well, if opening stock behaves like an expense, closing stock should behave like a revenue. And that is actually correct. So closing stock, as you can see, is subtracted from cost of goods available to give us cost of goods sold. So closing stock technically decreases the cost of goods sold. So that means it's decreasing an expense. So it's kind of behaving like returns out, and returns out behaves like a revenue. So again, let's try not to overcomplicate things. Let's just take a look at what happens to net income when we change closing stock. Okay? So we want to start by overstating it first. So if we overstate it, it's going to go up to 25. So this should go up as well. Let's see. So overstate closing stock. 25,000 overstated by 1,000 and 31,000 also overstated by 1,000. So we were correct. Now, what about if we understated it instead? So it'll go down to 23 and this should go down to 29. If it does, there you go. See, understated by 1,000, understated by 1,000. So they move in the same direction. So closing stock behaves like a revenue, opening stock behaves like an expense. So we're going to treat them accordingly. Let's go back to the Word document and work out a little table as with the rest of the items. Okay, so for example 4A for inventories, net income is 75,000, but the following errors are found. So opening stock is overstated by 12. Closing stock is also overstated. So let's put in the net income of 75. Now if opening stock behaves like an expense. So it's a net income move in opposite direction. So if opening stock is overstated, it's too high. To fix it, we have to bring it down. And when you bring down an expense item, profit goes up. So we are going to have to add the overstated opening stock amount in the process of correcting net income. Similarly, closing stock is overstated by 8,000. Overstated means it's too high. Now, closing stock behaves like a revenue. If it's too high, to fix it, we have to decrease it or bring it down. When you decrease a revenue item, profit is going to decrease as well. So we are going to have to subtract the overstated closing stock amount in the process of calculating the corrected net income figure, in this case, 79. Let's take a look at a second example. So example 4B for inventories, we have net income is 90,000, but the following errors are found. So we have opening stock understated by 20, closing stock understated by 18. Let's start with our net income before corrections of 90. Now opening stock behaves like an expense. If it's understated, it's too low. To fix that, we have to increase it. And when you increase an expense, profit goes down. So we are going to have to subtract the understated opening stock amount in the process of correcting net income. Similarly, if closing stock is understated, closing stock behaves like a revenue. It and net income move in the same direction. If it is understated, it's too low. To fix that, we have to increase it. And when you increase a revenue item, profit goes up as well. So we are going to have to add the understated closing stock amount in the correction of net income. Oh, I forgot to put the line item here. Right. Okay, so I'm going to give you guys a couple of questions to try now. Okay, so I've put up two questions here, and I've left the examples for you to use if you need it. So you know the drill. Pause the video, try the questions, and then unpause to the solutions. Okay, how did it go? Let's take a look. So, in exercise 4A, net income is 94,000, but the following errors were found. Opening stock was overstated by 15. Closing stock was understated by 27. Calculate the corrected net income. So we are going to put in our incorrect net income of 94,000. Opening stock behaves like an expense. Overstated means it was too high. If it was too high, to fix it, we have to decrease it or bring it down. When you decrease an expense item, profit goes up. So we are going to have to add the overstated opening stock figure in the process of correcting net income. By the same token, if closing stock was understated by 27, closing stock behaves like a revenue. Understated means it's too low. If it's too low, to fix it, we have to increase it. And when you increase a revenue item, profit goes up as well. So we are also going to have to add the understated closing stock figure in the process of correcting net income. And when you run your arithmetic, you're going to arrive at that figure there. Okay, let's take a look at example exercise 4B. So net income is 65, but the following errors were found. So we have opening stock understated by 36, closing stock overstated by 45. So let's start by putting in our net income before correction. Now opening stock behaves like an expense. Understated means it is too low. To fix that, we have to increase it. When we increase an expense item, profit goes down. So we are going to have to subtract the understated opening stock figure in the process of correcting net income. Similarly, if we have closing stock being overstated, that means closing stock is too high. Closing stock behaves like a revenue. If it's overstated, it's too high. To correct it, we have to bring it down. And when we bring down a revenue figure, profit comes down as well. So we are also going to have to subtract the overstated closing stock figure here to arrive at our, well, in this case, look, we actually get a net loss. So that is quite possible to get a net loss. Okay, if you guys have any questions about these items, again, I know they could be a bit confusing because they're not they're not expenses or revenues, they are assets. So how come we treat them like that? Again, you could go back and rewatch what I did with the income statement. You can try doing income statements on your own, preferably with Excel, so you don't have to write over everything a dozen times. and get fed up and bored of it. Okay, so those are the 4 categories of items. What I want to do now is bring them all together. Okay, so now we are going to try all of these different types of errors in one question. So we have an example here. So the net income of Phenomena for the year ended 31st December 2017 was initially calculated as 105,700. Upon inspection of the accounting records, the following errors were discovered. So let's go. Sales was understated by 15,000. Commission revenue was overstated by 2. Rent expense understated by 3. Wages expense overstated by 4. Returns in understated by 5. Returns out overstated by 6. Opening stock overstated by 7. Closing stock understated by 8. And we have to prepare a statement of corrected net income or net profit from the above information. So we are going to start off with 105.7 as our net income before correction and do one item at a time. So let's start off with our sales figure. So sales was understated. Sales is a revenue. Understated means it's too low. To correct it, we have to increase it. When you increase revenue, profit goes up as well. So we are going to have to add the understated sales amount in the process of correcting net income. Next, we have commission revenue being overstated. Revenue being overstated means it's too high. To correct it, we have to bring it down. When you decrease a revenue, profit decreases as well. So that means we are going to have to subtract the overstated commissions revenue figure in this process of correcting net income. What happens next? Rent expense was understated by 3,000. So rent expense understated means rent is too low. To fix it, we have to increase the expense amount. And when we increase an expense, profit goes down. So that's going to have to be subtracted in this process across here. Next, we have wages being overstated by 4. Overstated means it's too high. To fix it, we have to decrease it. When you decrease an expense, profit goes up. So when we go on this side now, we can add that overstated expense item to correct the net income figure. Next, returns in. Returns in behaves like an expense. Drill that in your brain. It's understated, which means it's too low. To fix that, we have to increase it. And when we increase an expense item, profit goes down. So in the table across here, we are going to have to subtract the understated returns inwards figure. Next, returns out was overstated. Returns out behaves like a revenue. Overstated means it's too high. To fix that, we have to decrease it. And when you decrease a revenue item, profit goes down as well. So across here in our table of correction, we're going to have to decrease that or subtract that figure, in the same process of correcting net income. Next, we have opening stock was overstated. Opening stock behaves like an expense. Overstated means it's too high. To fix it, we have to decrease it. When we decrease an expense, profit is going to go up. So we are going to have to add this figure in the process of correcting net income. Next, finally, we have closing stock being understated. Closing stock behaves like a revenue. Understated means it's too low. To fix that, we have to increase it or bring it up. And when you increase a revenue, profit goes in the same direction. So we have to add this figure here as well. And all we have to do now is add and subtract going down to get our corrected net income, or corrected net profit, I should say. Try to be consistent with your words. Okay, so I know that was a lot. You may want to review, rewind, whatever you call it, but I want to put up a question on the left-hand side for you to try. Okay, so on the left, you have a question there. So pause the video, take a read, try the question. I've left the example up for you if you need it. And of course, unpause when you're ready to see the solution. Okay, so how did it go? It took a little while, right? That's okay. That's part of the process. So we have alcoholic for the year, and the net income was initially calculated as 58.5. We discovered some errors. So instead of going through them one by one and then correcting them, let's correct them as we go through them. So let's just start off by doing the net income before correction, 58.5. First thing, sales account was overstated. Overstated or overcast means it's too high. To fix that, we have to bring it down. When our revenue decreases, profit decreases as well. So we are going to have to subtract the overstated sales figure to correct net income. Next, we have rent revenue being understated. Understated means it's too low. To fix it, we have to increase it. When you increase a revenue, profit goes up as well. So that means that we are going to have to add the understated rent revenue figure in order to correct net income. Next, we have electricity expense being overstated by 2,000. Overstated means it's too high. To fix it, we have to bring it down. When you decrease an expense, profit goes up. I'm hearing some of y'all catching on to this thing. So we have to add that back in the process of correcting our net income figure. All right, next. Telephone expense was understated. So understated means it's too low. To correct it, you have to increase it. When you increase an expense, profit goes down. So we're going to see that on this side here. We have to subtract the understated telephone expense in order to arrive at the proper or correct net income. Now, returns in behaves like an expense. Overstated means it's too high. To fix it, we have to decrease it. And when you decrease an expense, profit goes up. That means we're going to have to add the overstated returns inwards figure to correct net income. Returns out, on the other hand, was understated. Returns out behaves like a revenue. Understated means it is too low. To fix it, we have to increase it. And when you increase a revenue, profit goes up as well. So to correct net income, we're going to have to add the understated returns out figure. Now, opening stock behaves like an expense. Understated means it's too low. To fix that, we have to increase it. When you increase an expense, what happens to profit? It goes down. So we are going to have to subtract the understated opening stock figure in the process of correction. Finally, we have closing stock was overstated. Closing stock behaves like a revenue. Overstated means it's too high. If it's too high, we have to decrease it to correct it. And when you decrease a revenue item, you have to subtract. Right? Profit goes down. So now, what happens is our corrected net profit is 42.5. Whew! How did that feel? Kind of tough? That's all right. You get accustomed to it. Okay. Okay, guys, so there you have it. That is how we correct net income when there are errors in the income statement. Now, of course, like I said, there were 4 categories of items, and there may be other things that may appear in the income statement that don't necessarily fall in those 4 categories. But then what you'll do in those cases is you'll treat them like how we treated the inventory items or the returns items. But that means you need to understand the inner workings of your income statement. Does this item increase or decrease profit? Right? So again, read your questions carefully, take your time, practice more questions. Now, if you guys have any issues with this stuff in the video, any questions about the material, please feel free to leave those questions in the comment section below. I'll be happy to get back to you. Anyhow, guys, if you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and check out my website for some free payaway handouts. Thank you so much for watching. I'll see you guys next time. Bye.